Here on BT, not sure if you know, November is Financial Literacy Month, so we thought we'd bring on one of our favorite guests when it comes to money, contributing editor for Money Sense magazine, Bruce Ellery, over in Toronto. Good morning to you, sir. You're going to help us with our money. 4 most common mistakes investors make with their money, and you make the key point. It all starts with attitude.
It all starts with attitude. You know, Canadians are so disengaged when it comes to investing. Like, we're just like lying on our bed going, I'm just going to have a nap here, pretend it's not happening. That's how we are. We can't do that anymore. We got to stop. We got to pay attention. Are you paying attention, Riaz? Are you paying attention?
How can I not? You're so animated this morning. I'm focused. What are we paying attention to when it comes to attitude?
So many things, but the number one thing is you need to have a basic investment plan, right? Have a basic investment plan so you know the asset classes you're in and the proportions that you're in. And then secondly, check on it once a year. I have a very low bar. But those are 2 things that Canadians need to be doing that they're not currently doing.
Okay, so for Canadians, we're going to check in once a year and start the accountability. Now, the idea of portfolio, we love our country. Maybe we love our country too much when we look at international representation in the portfolio.
Yeah.
What do you advise?
We have too much Canada, Riaz, by and large, and I love this country. I love Vancouver. I love the West. I love the Grouse Grind. I love Vijas. I just love so many things about our country. But when it comes to our portfolio, most Canadians have way too much of it. So, you know, if you look at what you've got, some people have 40, 50, 60% of their investments in Canada. And this is a problem because our Canadian market accounts for just 4% of the world. It's called home country bias, and so many countries have it. It's the same phenomenon in the U.S. It's just not as problematic because their market's so diversified. Here are the 2 problems. Number 1 is it means you're focused on 2 sectors, banks and energy stocks. That's mostly what you have if you're focused on Canada. So you are missing out on the growth that comes with technology stocks. You want a little bit of Google and Facebook and Apple and all that stuff. We don't offer those. We don't have those companies here to a large extent. They don't make up a big portion of our market. So you need to be thinking outside, and in particular, some of the bigger cap companies in Asia and Europe. And there's lots of simple ways to do that, but let's broaden our horizons outside of what we know, which is at home.
So we'll ask those questions to our advisor, but the idea of growth comes with some element of risk. Can you break down the difference between practical and psychological risk in the portfolio?
So the practical risk is what happens to my lifestyle if the market declines. The psychological risk is how do I feel about that? And those are 2 separate but interrelated things that are really important, because a 23-year-old saving for retirement can take a much higher level of practical risk than a 63-year-old with 2 years to go before they need that money to put groceries in their fridge. That being said, psychologically, they might have a very similar risk profile. Neither of them want to be in the stock market because it's too scary. Well, for the 23-year-old, we need to help them see that if they don't take some risk, they're not going to get the reward, and inflation's going to eat their lunch over time. But for a 23-year-old, they've got 30, 40 years until they need that money. They can withstand the market gyrations in a practical sense. Maybe psychology, they need to sort of get that sorted out. So it's really important to look at risk, to diversify appropriately, but pay attention to both those 2 paradigms.
Okay, and with risk, that's important for the portfolio, but with all of these transactions come fees, transaction fees, expense ratio, management fees. What are the key questions we need to ask as investors to truly understand how much we're paying?
So if you're working with an advisor, ask them to break it down and show you a percentage and absolute dollar terms. There's some new regulations that require them to tell you a lot more about that, and it's on your statement. But really understand what that amount is and see if you are getting value for the price that you pay. You know, we have such a hard time doing that math mentally when it comes to investing. We don't have a hard time doing that when we go out for dinner. Like, you go out for dinner and it's a $50 meal. It was good. It was a $100 meal. It was great. You can have a sense for whether or not you're getting value for the money that you pay. With investing, it's much harder, and it matters so much more. So if you pay 2.3%, which is the average management expense ratio for a Canadian mutual fund, that will be hundreds of thousands of dollars more than if you paid under 1%. So I don't care how you do it, exchange traded funds, low fee mutual funds, maybe you buy individual stocks. I don't know. If you're paying those fees, you want to make sure that you get the money, you get the value for it. So if you're working with an advisor and they offer tax planning or estate planning, planning or whatever else they can do. Ensure you enable them to help you get a handle on your holistic financial life, all of it, not just the investing and, where should I put my RRSP contribution room this year. They've got a lot more value to add. You just need to make sure that you're an informed consumer and you ask for it.
I should start calling you Professor Celery. Ring the bell. School's in.
That's good.
Great education right here. Bruce, thank you very much. Appreciate all the insight. Take care of that.